Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. So welcome back, Art Jarvis, to what it turns out is this is the 10th edition of Taking Stock.
It's our 10th. Is it the 10th anniversary? Is that what you call it?
Well, this is just the 10th edition.
Okay, 10th edition. All right.
We haven't been doing it for years,
Yeah.
weeks,
Yeah.
months at this point.
Months, yeah.
We got into months.
Well, it's good to be
People
back.
are loving it.
Hey, apparently it did get some great comments, so I appreciate you, and it's good to be here again.
And so today, it turns out that we're going to talk a little reality about what's going on in the economic world and the investment world. Mm-hmm. So, what's up?
We've had quite a bit of drama here in the last 2 weeks. We've had some economic numbers, which honestly have been pretty good. The employment number came out on Friday, and it was substantially better than expected. But the interesting thing to that is the market dropped 1% on that news in the morning, but then it worked its way back, and we finished up almost we finished up 1.2%, but we were up one. So you had a 2.5% swing.
That was Friday.
On Friday,
wow.
Yeah. So it was really bad, but then everyone's like, and we had kind of gotten into that where bad news is bad news and good news is bad news, right? But it's today's Tuesday, October the 10th. Oh, it's our 10th episode on the 10th.
10th episode on the 10th of October. 10,
yeah.
10 and the 10th.
Yeah, might have to go play the lottery or something. But
speaking of which, did somebody win that $1.4 billion?
No, it's 1.55 now.
Wow, okay. You need to go buy it.
Well, as I always say, I don't need to win the lottery. I just need a client to win the lottery. So,
okay, fair enough.
But anyway, we digress. But so Friday was, finally it seems like in the last 2 days actually we've had three, and today we're up 1.1% so far. We've had 3 really good days since that employment report. So
people can't see, as we talk about it being up 1.1% so far today, and Art's glancing at those numbers live as we're talking. So, folks, it is at this hour, basically the noon hour on Tuesday, the 10th of October, we're up 1.1%. What will the swing be today?
Well, no swings today, please.
I'm just going to go
everything's green. And if everything's green, it's a good day. So we'll take that. So we still have good economic numbers. We've talked about that in the past, and sometimes they're not as good as people want them to be, but they're still good. So we talked longer term trends. So you look at the longer term trend on some of these economic numbers, they're still looking good. So that's a good thing. Problem is the market was up 10 or so % by the end of July of this year, and by the end of September we had basically given it all up. And the biggest driver of that was the interest rates kept moving up, and if you look at like the 10-year bond, it got up to 4.9%. Yeah. So that was driving a whole lot of fear and a whole lot of concerns, and we gave up most of our gains this year because of it. But it's interesting, here we are again. We've really popped back up here in the last few days. So hopefully that will continue, and we'll finish the year strong and have a nice Santa Claus rally and things. So
we'll take a quick sidetrack too and go through that. But hopefully it'll continue. What's the impact? Because the news the last few days hasn't been the economic news so much as it has been we're going to call it the unrest in the Middle East with the Hamas and Israel, the Palestinians, and what's happening there, or What's your concerns about that happening and the impact that it may or may not have on the economic trends?
Well, interestingly enough, it has not had an impact on the markets here. The cynic in me is, Palestine does not produce oil. Israel produces about 300,000 barrels per day, so it's not substantial in the scheme of things. So the direct immediate impact is, the market was, well, this all happened after the close on Friday, but yesterday we were up 0.6% or something like that. Today we're up 1.1%. So apparently the immediate impact has had no impact.
Okay.
The greater concern is what's, who gets involved. I mean, Iran has already come out and threatened to remove us from the face of the earth if we get involved, and the United States.
Sure,
gets involved.
right.
So but you do have that kind of thing. If it remains contained in that area, then it's unfortunate and it's a terrible thing in my opinion. But the direct impact on our economy and the markets is pretty close to nil. The only thing and we talked about this, fear and greed. I mean,
right.
it does, and that's what happened. At first, there's fear. Well, what does this mean? And is that going to expand? And that fear was quickly alleviated for the time being, anyway. So
right.
So but
we're not happy about the unrest and all the other
sure.
things it means. But at least in these first couple of days, as that happened through the weekend, and now here we are into Tuesday, and at least the economic numbers here are still good. So
and we'll continue that way. And again, we'll keep an eye on the consumer. The consumer is going to continue to be the big driver, and we're heading into the holidays here. We'll see how the consumer acts here in the final couple months of this year. And the other thing is we're heading into an election year, and typically election years are pretty good years in the markets because. Mostly probably because we get promised everything and we get told how great things are, right? So it's a little more positivity than what we've had lately. But speaking of that, the other drama, which is much more aggravating to me, is what was going on in the House of Representatives last week. We unnecessarily removed a Speaker of the House that didn't, in my opinion, need to be removed.
Right.
Okay.
Giving away a little politics there.
It's not, again, I tell my clients...
That's not party alignment. That didn't need to happen.
That's me being anti-drama, is what I am. We have enough going on in this world. We have enough going on in our economy. We have enough things that we're concerned about. There's still concerns about inflation. There's still concerns about... everyone's worried about a potential recession. That word is still being thrown around.
Right.
We have all these things that we still need to take care of in this country, and our political leaders are worried about getting rid of the Speaker of the House.
Yeah.
Okay. He didn't do something illegal. He didn't do something immoral, unethical. Right. He just made somebody mad, and that got him removed. Right. And the problem with that is now basically the House of Representatives is shut down until we have an interim one,
right?
But until they elect or appoint a new Speaker of the House, which, by the way, the last time they did it back in January, it took 15 votes to get McCarthy put in there.
Yeah, it was a lot. It was a lot of votes.
It's a lot of votes. So here we are again.
It was a highly contested issue.
Yeah, and they just passed the whole to keep the government up and running for 45 days.
The good news, though, despite the 15 votes, the amount of time it took to accomplish that was not really lengthy. So there's still hope that we're not going to be sitting here, what do you want to say, treading water,
right,
doing nothing while we're waiting for a new speaker to be, for the speaker to be replaced. It's going to happen fairly quickly.
I would hope so. Let's put it that way.
Well, you know what? What's the concern? What's the concern with that in terms of the economic impact? What's the concern with a stalled house?
Well, again, let's look at the 45 days for keeping the government up and running. I mean,
right.
If they aren't able to work on a deal to come up with a longer-term solution, and then if we end up having a bunch of government workers on furlough or whatever you want to call it, then that has an impact. Now, of course, it'll end up being retroactive, and they'll get their money anyway.
Right.
But it causes a speed bump in the economy. The other thing is again, uncertainty. People don't like uncertainty. So if you tell them we're shutting down the government, that causes a knee-jerk negative reaction. Okay, now the long-term impact might not be that great, but it doesn't matter. It's how people perceive it, right? So.
Yeah. Well, uncertainty, Art, is like, I'm glad you said that, and that's a key word. And it surprised me a moment ago when you were talking about, so we're heading into an election year. Mm-hmm. And election years, apparently I didn't pay that close attention. Election years generally are good. Mm-hmm. And I was thinking what you were going to say is we're heading into an election year, and then that's going to be uncertainty and some negativity and a stall in the economy. So I don't get that, because if uncertainty is that thing that sometimes causes, the stall or another speed bump or whatever the case is with the economy, the uncertainty of an election year doesn't have that impact.
Yeah, I think
generally,
yeah, generally the actual election year is positive. Now, what happens after the election is up in the air, right? Depending on who or what happens.
Administrations change. We know what's happening, and guess what? A change. Somebody else gets elected, everything changes, and then there's real uncertainty. Mm-hmm. Right. I guess that's what we're...
Precisely. And basically we were at roughly a 50-50 split in this country, right? So we'll see how this election goes, but, you're somewhat uncertain of what that election day is going to look like, right? I mean, which way is it going to go? I mean, in elections past, you were pretty certain how things were going to go. But during that whole time frame, there's going to be a whole lot of rhetoric coming from these individuals, and a lot of that's going to be telling us what great things they're going to do and how much better things are going to be, right? So maybe people grasp at it and take in and have a little hope.
Well, as you said, the promises and the I guess basically the sharing of how good things are, because that's the message that a candidate wants to get out there is, the good.
Yeah. And how does that pass on? I mean, so if that causes consumer expectations to become more positive, and that causes consumer spending to go up a little bit, and things like maybe people, again, we've talked about, I need a washer and dryer, or maybe I have this expense. I'm trying to consider whether I want to make that expenditure or something. Maybe if things are a little more positive, they make that expenditure, and that tends to help the economy a little bit and things like that, as opposed to if I'm scared to death and I'm worried about a great big recession coming or something like that, guess what? I'm not going to make that purchase because I'm fearful of what's coming down the pike. So.
Well, we talked, and we talked about that. I won't say extensively, but we touched on that pretty solidly in episode number 9. And so here we are in 10, and we're talking again. And probably every time we talk, you have to talk about consumer spending. Yeah. And you and I both said what we've witnessed is people are out there spending. Mm-hmm. What we didn't talk about, that is a fair question, is how about consumer debt? Yeah. Because they're spending, but are they spending money that they have, or are they accumulating credit card debt or loan debt? Mm-hmm. That's how is that number measured and gauged?
That's a very fair question. I think we are in, and that's the one thing, and we also want to talk about how to remember. But we are in that phase where we have almost or have burned off all of the COVID money, all the money that we received. That whatever $6 to $7 trillion that went into the market over a period of time. I think people have burned through or almost burned through all that money, and so to answer your question is burn through that money. Now we're talking about the debt moving back up again. So which is interesting. Number one, in our households and in our local governments and in our state governments, that's a bad thing, right?
Right.
But you go to the federal government, we just keep raising the debt, which somewhere along the line that's not a good thing, right? But yeah, it's that will have an impact, and what the economy does and what the employment picture looks like and things like that will all have impacts on those kinds of things, because if we do roll into a recession, and whatever it ends up being, 2025, 2026, and how much debt do you have, and if we're in a recession and you're losing your job and you got a bunch of debt, that's a problem.
Big time.
Right.
Yeah.
So, the other thing I was going to mention is we were talking about interest rates. Is we're kind of in this trend. Been in the business for 36 years now. And we're where we are from an interest rate standpoint right now is still lower than where we were in the 90s and the early 2000s. Right. We went through
big time.
We went through a decade where interest rates were very low, and we became used to that, right? That was the norm, the new normal.
Right.
Well, the problem is now we have a new normal. We're not
a new normal.
Yeah, that's I'll patent that, trademark that or something. But this isn't a situation where interest rates have risen 5.25%, 5.5%, whatever it is, and we're gonna get through this and we're gonna drop back down. It took a decade or more for us to go from 8% to 3% interest rates, right? We're not gonna go from where we are today. So, us as consumers and things like that, we have to get used to. We're not where we used to be. These new numbers are going to be kind of the normal, for at least for the time being, right? And that has an impact on your. The one I have a friend who's in the mortgage business, and I was talking to her last week. I asked about business being slow, and her comment was business isn't slow, business is completely stopped. And that's
the mortgage business.
That's the mortgage, and that's diametric to what it was just months ago, where she didn't have enough time to get everything done. So now here we are, where she's like, "I'm sitting here doing nothing." So that's how much that has changed.
I think that the higher interest rates. I mean, I think that's the first place that scares people. That fear, that we've talked about. So fear. I don't want to get a new mortgage. I don't. So, and then that spreads across the mortgage industry. Means the real estate industry, means the home buying industry, means the home selling industry. And so if that's stopped, the real estate world is slowing.
That's right. Yeah.
That's what we know.
Right.
But that's the thing to me anyway. That's that big item, and that's where the interest rates are felt, is on mortgages. I mean, so people are like, whoa, wait a minute.
Yeah. Well,
my mortgage is going to cost me more.
Yeah, mortgages, and then if you look at it from a business standpoint, again, I have another friend who bought a business 3 years ago, and his business loan was 5%. Well, guess what? His business loan is 10% now. It's whatever time plus prime, and that puts him. So his debt service for his business has gone way up in the last 2 years. And then if you want to carry that over to the U.S. government, we've talked about this in the past. When we had low interest rates, our debt service on $33 trillion of debt was a lot lower. Well, that debt, as that debt matures and we have to refinance it or roll it over, we're going to be paying a much higher interest rate. So our debt service is going to go way up. And I know I gave you the number several episodes ago, but I can't remember what it was, but it was a tens of $billion number on a monthly basis. It was a big number,
right?
So that has an impact. But you have, again, this is a whole. I'm not going to go out, and everyone talks about interest rates dropping on mortgages. Well, guess what? We're not going to drop back down to 3% on a mortgage anytime soon. This will be literally a decade or more. If it happens at all. It's not the higher interest rates, which is the reason for starting to talk about it was, that was one of the biggest drivers when it comes to, the market having given away basically almost all of its gains for the year. But
and that was an amazing thing when you said that as we started, this episode. Talking about, so July it was, we're there, And in September, we gave that all away in terms of the gains. It was at 10%, and now it's, we call it even. That's the word that you used before. Basically, we're at even. The good news is it's climbing again a little bit, headed in the right direction again a little bit.
Yeah.
But the idea that we gave gains away is, the word again. I'll say scary, but that's that fear factor.
Yeah.
Of, the other word that is commonplace, I guess, is volatility.
Right.
So is the marketplace, from your point of view right now, volatile?
From my standpoint, it's very volatile.
Yeah.
I mean, there's been worse times, let's put it that way. But when the phone starts to ring, and I really, my clients are great. They usually are willing to stick with the plan and things like that. But you went through 2020, which was whatever you want to call that. You got 2021 where we made a little bit of money. We got 2022 where everything was basically down 18% or more, whether you were looking at bonds or stocks or things like that. 2023 looks like, okay, we're making some gains. We're starting to see some positivity and things like that. And then all of a sudden, within a very short period of time, it's taken away from you.
Right.
So people get aggravated. I get aggravated because, and again, why is it dropping? So if this is 2008 and we're getting ready to head into the financial crisis, the market dropping made sense.
Sure.
Okay, and there's things you can do to make that drop easier, or counterbalance that drop. When you have the market dropping for what I'll use a better word. I'll use poor reasons. Okay. People unnecessarily stirring the pot. People saying things. And Fed Chairman Powell, we've talked about this before. Also, he has several vehicles he can use to manipulate the economy. One of them is jawboning. Well, he's very good at using the jawboning. To talk. He can talk interest rates up without actually raising interest rates. Well, that's basically what has happened. He went to Jackson Hole, and everybody was expecting him to take a little bit more of a moderate stance in his speech. Well, he comes out and says, no, we're going to raise interest rates some more this year. Well, that's what got it started. So next thing you know, the 10 years at 4.9%. And the problem with that is let's say the S&P 500 is predicted to have $250 in earnings this year. Well, you got to multiply that times some kind of market multiple. Well, the market multiple you multiply the earnings to get your PE ratio, the market multiple decreases as interest rates go up. So what I'm looking for 6 to 18 months from now is, if I'm taking those forward earnings and applying and multiplying it to another, a market multiple, well, that market multiple is lower, so my potential gains for the future are dropping. Yeah. And that's part of the problem here over the last month or so.
Wow.
So,
well, we always get toward the end of each episode, and I say, well, so let's go back to the positivity. or at least what are the strong messages for me, you, and all the other individuals for our household investing and our personal economics? I'm going to sneeze here, so excuse me.
All right.
Excuse me, I apologize. Anyway,
but
so what's the positive message, or what is the message for individual investors like me and you and all of our good friends?
Yeah, I think the message is still the same. I mean, I look at things from a long-term standpoint. I'm still looking at economic numbers that I believe, number one, aren't supporting a story that's calling for some especially a big recession anytime soon, or any recession, frankly. Still haven't seen any kind of numbers come across that would support that. You're still seeing increasing corporate earnings projections. So, again, I'm a numbers guy, and this is the only way to make sense of the world for me is to pay attention to the numbers.
Right.
And look at the numbers from a trend standpoint and look at them from a longer term standpoint, not get bounced around on a monthly basis. If I'm looking at that, the story still hasn't changed. Now, am I trying to tell you that we've got 20% potential upside in the market? No, not right now. Not where interest rates are. But am I looking for the market to drop 20%? Most certainly not. So, as always, stick with the plan.
Stick with the plan.
Right. Yeah.
And you know what? And today we started this saying, we were going to talk a little reality. So I think we covered a lot of things about, things that are happening that could be of concern, and things that are happening that are reason to say we shouldn't be concerned. But the reality is, stick with the plan.
Yeah.
At the end of the day.
Yeah. I just think again, I came in here a little aggravated. I think I sent you a message this week that we've got a lot to talk about.
Right.
And especially when I sent you a message, I was aggravated. I just, there's good reasons and bad reasons for the markets to move around. Unnecessary stuff is what aggravates me. Yeah, and the things that went on last week just aggravated me.
Right.
So
what we're looking for is for things to settle in the House of Representatives.
That would be a
first
good start.
and foremost. Yeah. And I also say, obviously we have to keep an eye on what is happening in the Middle East and how that will or will not impact the economy, the global economy, but certainly our own economy, which seems so far the first few days, it hasn't had that impact that somebody might fear.
Sure.
But those are the things to keep an eye out.
Yeah, and don't get me wrong. What's going on there is a terrible thing. Take the economics out of it, and oil and all that. It's for humanity. It's a bad thing, obviously. But
no, you and I both sitting here know that the concern is for the people, for the humanity, for the life, and all that will all that's already been lost. We would sit here and say needlessly.
Yeah, that's right.
And that's funny because that's at the end of the day. Right now, you're talking about. That's what aggravates you is the needless changes or volatility in the marketplace that happen within the house and what have you. So
yeah, exactly. So
everybody at home listening, stay the course.
There you go. The message is the same.
No need to panic. Do not let fear drive your next move as an investor. And, just if you are concerned, talk to your professional investment advisor and stick to your plan.
That's right. And if you win the lottery, give me a call.
Well, I was going to tell them to call me, but anyway. So that is, And on that note, that is today's edition of Taking Stock. Art Jarvis, thank you again for joining us and sharing your insights as to what's happening in the economic world and the investing world.
Yeah, my pleasure. I appreciate you. Thank you very much.
You bet. Until next time.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.